What's wrong with the European banks? The European governments have taken several steps to ensure that another economic crisis doesn't break out on the continent. Several European nations have been practicing austerity. As a result, there have been deep spending cuts and countries have run up fiscal deficits which are less than 3% of the GDP. The whole world has lauded the efforts taken by the government to bring the crisis under control. However, it would be incorrect to say that the European economy is still recession-proof. The biggest threat to the European economy now comes from its unstable banking system. The entire banking system is more than 291% of the GDP. Hence, if this problem is allowed to grow unnoticed quietly, the result will be catastrophic for the entire European continent. Rising costs of compliance. It is ironical that measures which have been taken to ensure the stability of the banking system are amongst the prime factors that are causing its destabilization. A wide variety of compliance measures have been introduced in the European banking system after the 2008 crash. The purpose of these measures is to ensure that the banking system always stays in good health. However, the problem is that increased compliance also means increased compliance costs. Hence, the various forms of compliance that have been imposed by national as well as supranational bodies in Europe are adding up to 4% of the total revenue of the banks. These costs are rising steadily and are expected to reach 10% of the total revenue. Such high compliance costs will make it difficult for the banks to sustain in the event of any external shock. Hence, they need to be rationalized as soon as possible. Propping up profits. A significant portion of the money controlled by European banks has been lent out to national governments. European banks are the biggest holders of national bonds on the entire continent. The problem is that the value of these bonds seems to be artificially inflated. In the past few years, the European Central Bank has been rapidly increasing the money supply. Most of this newly created money has found its way into stock, bonds, and other asset classes. Hence, the current value of the bonds seem to be inflated. As a result, the mark-to-market profits being recorded by the banks is also inflated. Hence, finally, the valuation of the banks which have been derived based on these profits is also inflated. Investors, therefore, need to have a harder look at the income statement and balance sheet to determine the strength of individual European banks. This will help them determine the odds of insolvency. Shortened yield curve. The zero interest rate policy followed by the European Central Bank is hurting the profitability of local banks. This is because banks make money by borrowing for the short term at low interest rates and funding for the long term at high interest rates. However, now both the short and the long term interest rates are very near to zero. Hence, there isn't profit to be earned in the form of net interest margin. Increasing insolvency rates. The European Central Bank has kept the interest rate meager. The interest rate has almost stayed at 0% throughout the period. Hence, the number of businesses facing insolvency is abysmally low. Low interest rates mean most borrowers can continue to make payments on their loans. However, as the Fed is aggressively increasing interest rates in America, the ECB is soon expected to follow suit. Also, the zero interest rate policy cannot continue for a long time. Thank you.